This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and begin our journey through the chapter on equity finance by going through and looking at quoted companies. So companies that are already listed on an active market, so on a stock market such as the London Stock Exchange, the NASDAQ over in America, or any other recognized global exchange. Okay, and we're going to look how those companies can go through and raise large amounts of finance by issuing more shares. Okay, we will go on in later videos to look at how unquoted companies can raise equity finance too, but the focus for now is looking on those already listed businesses. You probably know many of them that are in existence. So all these global companies that we have, Facebook, Starbucks, Amazon, they're all listed on a stock exchange over in America. Okay, whether that's the NASDAQ or on Wall Street. Okay, the New York Stock Exchange. So let's go through and have a look at it. I think there are, if memory serves me right, my memory is fading as we work through all of these chapters. But I think there are 4 different methods over which a quoted company can go through there and raise finance by issuing shares. Okay, first one that you've got is going through there and looking at a public issue, or is it there referred to as an offer for subscription? Very straightforward idea. You go through, decide to issue a large batch of shares to new shareholders. So you don't approach the existing shareholders. It's not like a rights issue. It's a brand new issue of shares to new shareholders. So you're inviting people in to join the party. Okay. Key bit is that your shares are currently traded on the market, so you know what the shares are currently worth. You're going to take the money that you raise from issuing the shares and invest it in a project that generates you some NPV, doesn't it? You'd expect that to happen. Take the money, invest it, and make the shareholders richer. But the issue that we have is that the way a public issue of shares works is that you set a price for those shares that the new shareholders are expected to pay. Okay. The issue that we have is looking at that share price that we expect the new shareholders to pay, and then comparing that to the current share price that the current shareholders have. And what we will find there is that there will be some form of gain made by the old shareholders, a gain made by the existing shareholders, and we'll come in the example in a moment and see that there are issues there. Okay, because these new shareholders have just joined the party, haven't they? You know, that they shouldn't really be getting huge amounts of the gain from the NPV of the project. Yes, by all means give them some, but you know, the old shareholders have been around for a long time. You know, maybe they should get the benefits from most of this project. But that's the issue that you've got: setting the price, setting a correct price that is attractive to the new shareholders, but also doesn't degenerate the ownership, or if you like, the gains and the wealth of the current shareholders. Okay, so quick recap. New issue of shares, nice and simple. You issue it there as a public issue to new shareholders for a fixed price. Okay, mentioned it there. Okay, is that there a fixed offer price? Okay, however, it is difficult in practice to determine that offer price. Okay, shall we work it through with the example and show you why and how? So our example that we have there, the new share issues and pricing. What you've got there is in part A, it wants the gains accruing to the new and existing shareholders if the shares are issued at $2.40 each. So in part A, the new shares are going to be issued at $2.40. So that's what the new shareholders will pay. What gain does the new shareholders make, but also what gain do the existing shareholders make? You know, the money that is taken from the new shareholders are going to be invested in a project. That project will generate wealth, so via NPV, and therefore that then needs to be split between them both accordingly, doesn't it? How will it be split if the issue price is there at $2.40? Okay. So first of all, note in part A, it's asking you for the gains. whereby in part B, it's asking you for the share issue price, so a different figure, if all of the gain is to go to the existing shareholders. So the new shareholders don't get anything whatsoever. Okay, they provide the money, they can get wealth at some point later in the future when other projects develop based on the success of this project. We're going to reward the existing shareholders for their loyalty by making sure that all the gains go to them. Okay, but that's whereby we will go through and see potential issues. Okay, so what have we got? The way in which I'd answer both questions, A and B, is to go through there and set up a table. Okay, so let's look at it there. Is it from part A? The table's going to have, I think, 5 columns, if memory serves me right. So what we're going to go through and look at in the first column is we're going to look at the shareholders and the type of shareholders. So we're looking at the old. We're also looking there at the new shareholders as well. I'll just move that down to give myself a bit of space. In the next column, we're going to look at the number of old shareholders and the number of new shareholders. So how many shares do they own? We're then going to go through that and look at the share price both before and is it after. So that's looking at the price. And then what we're going to go through and do is we're going to look at the gain. So we can look at the gain in total and then look at how that is split between the old and new shareholders. Okay, and if memory serves me right, this question was asking us what are the gains to the new and existing shareholders. So the figures that we're looking for are here and here. Okay, excellent. So what have we got there? Okay, so let's go through and read the information within the question. Okay, so it says that a company has 10 million shares in issue. So if we have 10 million shares in issue, that's the old shareholders. They have 10 million. So that can be the first thing that we look at. Okay. It then goes on to say that the shares in issue are the $2.50 each. So we can put in there, is it $2.50? So that's the price before. Is it there to the old shareholders, isn't it? Okay. What we then need to go through and do is we then need to read the rest of the question. It says, and is looking to raise an additional $2.4 million. So that's the funds. So when I look at the number of new shares issued and also the price before, okay, that needs to come. Is it there? To 2.4 million. Well, we know from the question in part A that the shares were going to be issued at $2.40. Why $2.40? Well, that's what's in the question. But what we can note from there is that the price is less than the current market price to entice the new shareholders to buy those shares. Okay, you're not going to buy shares if they're priced above $2.50, are we? Okay, you're not going to think, well, I don't know, let's pay $2.60. No, I can buy it off the market for $2.50. Okay, so it's priced below the current market price. If that's the case, I think you can work out there, can't we? That there are going to be, is it 1 million shares that need to be issued? Okay, so the 2.4 million divided by 2.4 gives you, is it 1 million, isn't it? Okay, excellent. Let's read on. What else have we got? The money from the new shares is going to fund a project with an NPV of $3.5 million. So what we have there is that the total gain needs to be there. Is it $3.5 million? Okay, that's not 4, is it? That's number 5. I'm just labeling them up so you've got numbers to follow if you work out similar questions. Okay. So what we need to be able to go through and do there is to work out the gain. We need to look at the price after, don't we? Okay. So what have we got? Okay, to work out the price after. Well, the price after, the way in which we calculate it is we need to start off with the old market value, don't we? Okay, because that's what the business was previously worth before this new issue of shares. So we start with the old market value. We then receive some proceeds from the new shareholders, and those proceeds then go through there and generate, is it, a net present value. So that, if you like, is now the new market value of the business, isn't it, in total? So the total market value, the total proceeds, and the total NPV. What we then need to do is we need to work it out on a per share basis. So we look at, is it the old number of shares plus the number of new shares issued. Okay, and all that information is in the table above. So the old market value, I think, is going to be, is it 25 million? There were 10 million shares, each worth $2.50 each. The proceeds that we've got are there, is it at 2.4 million? The NPV was the 3.5 million. You could just work in millions, but we'll put it in full figures. The old number of shares was there as 10 million. The new number was there as 1 million, wasn't it? Okay. If you tap that onto your calculator, what have we got? 25 million plus 2.4 plus 3.5 divided by 11. 2.8090909090909. Okay. So shall we just go through that and make that $2.81? Okay. There we go. $2.81. Make sure you remember how to work out the price after. It's the old market value plus proceeds plus NPV. So what have we got? Well, we now know, don't we, that the price after is $2.81. So I'll just reference that to my working so you can all see where that comes from. And the price after has to be the same for both the old and the new shareholders. Okay. So what's the gain? Okay. Well, let's work it out for the old shareholders first. 281 less the $2.50. Okay. They had a share at $2.50. It's now $2.81. So they make a gain per share, is it, of 31 cents. Times by 10 million. Do they go through there and make a gain, is it, of 3.1 million. Okay. Excellent. The new shareholders, there's going to be a little bit of rounding, but who cares? You've got 281. They paid 240 just a few minutes ago and made a nice big gain of 41 cents per share, just like that. Okay. Multiplied by 1 million, does that give me there, is it 410,000? Okay. Clearly that doesn't total up exactly. The reason why is due to rounding. Okay. There you have it. Okay, remember those two figures there need to be the same, and then you work out the gain per share and multiply it by the old number of shares, and the gain per share for the new shareholders and multiply it by the new number of shares. Okay. So The gain to the old is 3.1 million, and the gain to the new shareholders is 400 or 410,000. Okay, excellent. Everybody reasonably happy with that one there. Okay, excellent. Because what we're going to go through and do now is we've done part A. Let's go through there and have a look at part B. Because we're going to use part B and a similar approach, virtually identical, to what we had in part A, even though it wants us to calculate something different. It says here, calculate the share issue price if all of the gain is to go to the existing shareholders. So, right, let's draw up the same diagram. Okay, part B. So we've got there, is it my shareholders? So is it the old? And is it the new? We've got the number. We've got the before price. We've got the after price. And the gain. Okay. We know in this question, in part B, because the background information hasn't changed, is that the gain is there at 3.5 million. Okay, we know that all of that gain is now to go to the old or the existing shareholders. Why do we want it to go to the old or existing shareholders? Well, in the last example, part A, look what happened. These new shareholders paid $2.40 and in an instant gained by 41 cents per share and made a nice little quick gain. Whew. It's okay, isn't it? Okay, yeah, I know the old shareholders made a gain, but this project, you know, you're an old shareholder, maybe you want all of the gains. Okay, this is where the difficulty is in terms of the pricing, because we want to keep the old shareholders happy and the new shareholders happy. It's complicated in real life. So what we're going to try and do now is we're going to give the gain to those old shareholders. Okay, all of it, and we'll see what the problem arises when we get to the solution. Because what we're going to do now is the old shareholders, we still know, careful, let's put that in blue so we're consistent in our colours. The old shareholders had 10 million shares. The price before was $2.50. We don't know the price after just yet, do we? Okay. But we can work that out. And the question is asking us what is, if we go back to it, what is the share issue price? So in part A it was $2.40, and in part A there was the issue price, $2.40. So what we're looking for is this figure there. What are the new shareholders going to pay to get their hands on the new shares? Okay. How do we work it out? Well, we have to work in reverse, you know, because before we started here and worked our way over there to get the gain. Okay. Now, effectively, what's going to happen is we're working backwards. Okay. By working out the gain and using that gain to work out the price after. Okay. So how do we work out the price after? Well, I think this is a bit more straightforward than what we had before, because we know that the old value is $2.50. We're just going to go through there and add on, okay, is it the gain of 3.5 million and work that out per share. Okay, so we take the old value, is it there, $2.50, and then add in the gain. That's the gain that we go through there and make. Okay, so what we've got there, does that work out, if memory serves me right, is it at $2.85? Okay, so $2.85 is now the price after. Okay, if that's then the case, the price after for the new shareholders is also $2.85. And if there's no gain, which we have here, okay, then the price before must be $2.85. Okay, So what's the problem? We've answered the question. Okay. The answer there is $2.85 is the issue price to the new shareholders. Can you spot a problem there? If you're a new shareholder and you're told you can get a new share in Barlow PLC for $2.85, they're currently trading at $2.50. Would you be incentivized to buy that share? Hell no. Okay, you'd sooner go through and buy a new share if you really wanted to get involved in this company off the open market at $2.50. Okay. However, the problem that you then have is that you've got to reduce the issue price. You need to reduce the issue price to below the current market value to make it attractive. If we don't reduce it below the current market value, it's not going to be attractive, is it? And what's the problem there? If we reduce it below the current market price, then the new shareholders will get some of the gain. Okay, so these old shareholders have to accept that if the project is going to go ahead, if we're going to raise the funds, then the price is going to be lower than the current market value, and basically then you will have to accept that some of the gains will go to the old shareholders. Okay, there you have it. That's the issue. That's the difficulty in terms of the pricing. You can't price it above the current price, it won't be attractive, but if you do price it below, it becomes attractive, but the shareholders currently in existence lose out on some of the wealth of that new project. Okay, is that fair? I think it is. Okay, you have no divine right to take all the wealth of the project just because you've been in existence with the business for a long time. You have to share some of that gain, and if the new shareholders don't come along, there'll be no gain whatsoever. Okay, so we might as well share the wealth a little bit. Okay, something that isn't asked within the question, and I think it could potentially be asked as an exam question, so we'll throw it in. What are the new number of shares that are issued? Well, what we've got there is, to work that out, we know that we needed, was it $2.4 million worth of proceeds. The issue price is $2.85, and I think if you tap that on your calculator, you get 842,105. Okay, so you're issuing fewer shares when you issue at a higher price, so it saves you on issue costs. It's not going to work, is it? Okay, a new shareholder is not going to pay $2.85 to get a share that is currently priced at $2.50. So that goes through there, and using that example demonstrates the issue that you have with regards to a public issue. Okay, the pricing is very difficult to determine. Okay, in terms of examinability, I think that's a great computational style question that could be thrown in within the exam as an objective test multiple choice question, or as an objective test of entering in the number. Okay, so it could ask you to calculate the gains to the new or the existing shareholders, like you saw in part A. It could, in part B, we were asked to work out the share issue price. So again, that could be the requirement in an objective test question, to work out the share issue price. Alternatively, it might even go through there and ask the number of new shares that would be issued to give all of the gain to the existing shareholder. So that could be an extra or a different type of requirement. Okay, excellent. There you go. So that covers the first bit on, is it the new shares for quoted companies and the public issue. You can rejoin me in the next video when we look at the three other smaller aspects.